welcome. You're watching Bloomberg Quint. Today I have a very special guest with me at a time that the market cracks are taking center stage. Joining me today in this very special conversation, I have Sanjay Mookim, India equity strategist at Bank of America Merrill Lynch.
Good to be here, Davina.
Thanks very much for joining. And I'm going to start off with what's happening here and now. Up until now, we've been tracking what's been happening globally. You had a pullback of QE, you had trade wars, you had crude oil prices, the EM turmoil, which India seemed to be resilient to up until now, but looks like our armor is starting to get a few chinks and we are starting to look a little unstable.
Right. So first I will qualify, there was no had, we still have those issues in terms of the external stresses. And our concern as a house is that some of those are here to stay for a while. The Fed tapering, the QT is likely to persist for some time, especially if data and performance of the US economy remains robust. So the question is then, why was the India market as resilient as it was? A couple of guesses really, who knows the real answer, but one is that India was not perceived to be at too much risk from the trade wars. So if the Chinese market were coming off because of the trade war, India is an island in that respect. And the second was this whole argument of domestic liquidity and domestic support to markets. We did a note recently where I highlighted that it is not the domestic institutions, but it's the domestic non-institutions which had increased their trading share of volumes. If you look at the percentage of volumes that were delivered on a daily basis, that was crashing. The Nifty bid-ask spread was riding. So they were all classic signs of a liquidity event while the market was very, very high. And we highlighted that in our notes. And for one thing or the other, this was not sustainable.
Right.
Maybe this credit market issue is the tipping point, maybe it's not, we'll figure out. But our argument is that getting into elections, a domestic risk-off is very likely in India. Okay, which is why we have been cautious on the Indian equity markets for a while. And whether this or something else breaks the camel's back, we'll figure out. But I do think that there is further more downside to Indian equities.
Did the pace of this downfall surprise you? And the quickness of it and how fast it came? Because up until just a few days back, we were pretty comfortable on the Indian markets. In terms of valuations as well, we were at the upper end. So right now, the timing of it and the pace of this?
Well, look, it went up as rapidly as well. And as a result of that, India was trading at an all-time high premium to emerging markets on multiples.
Yeah.
Now, you could argue that was because the emerging markets has crashed and India had not and so on, but it is a relative investing world. And therefore, I am not surprised that it is coming off as well as, because it wouldn't have slipped. I mean, if markets were as prescient and as patient, then very few of us would have jobs. These shocks are unfortunately very, very frequent. So, the famous argument of black swans being not as rare as you would imagine, that's what's playing out.
Right. And in the same light, when you spoke about domestic investors, the foreign investors stayed on the sideline. They probably missed out on that move that we did see from January onwards. But now with valuations also, correcting a bit, do you see the flows coming our way, or it's still an emerging market allocation which India is a part of, so it may still get a slight sliver of it, but not much?
So there's two parts to it. One is the flows that happen on a passive basis, which is 100% linked to what happens to emerging markets and EM ETFs. So if there is an outflow from EM ETFs and passive money leaving EM, then India will have that same proportionate impact here. The second is then the active fund manager. Now the trouble with the active managers in looking at India is that valuations are still not at a zone where I would think you would press the button on India. You still, even after this recent correction we've seen, most stocks are still extremely richly priced. And the ancillary point I'd make here is that when the market starts falling, the ability and conviction of people to buy actually reduces, which is why we have cycles. So my sense is that this is not sufficient enough to attract flows. Currency, the external crisis is another concern around that.
You think the RBI and the government are doing enough for the currency?
Well,
or you feel this is a fair value for the currency?
Well, you could pitch it both ways. One is that the rupee needs to keep up with its other EM trading partners. So if the dollar is strengthening and other EM currencies are weakening as well, it is fair to let the rupee also depreciate alongside, because otherwise, imports from China would pick up, which would be another issue going forward. The question then is, what can governments or central banks do? If their stance is to manage the volatility of the move rather than to defend the level of the currency, I think that is fair. Okay, because volatility can hurt businesses, really it can hurt investment sentiment. Also, is $400 billion enough of an ammunition to defend the rupee? Perhaps not. Okay, because
everyone so far is saying that they're comfortable on that.
Yes.
The reserves are comfortable. So
well, it looks like a big number, $400 billion. But in terms of the number of months of imports, in terms of cover of the short-term debt we have, it's not particularly high. It's probably still where it was in 2013 or 14. Okay, so maybe we have another $30-40 billion worth of selling power with the central bank. But that's about it. So I don't think we are in a situation to start to aggressively defend the rupee just out of an ego issue.
But the RBI hasn't any which ways doing all that much. They've sort of left the rupee to find its own natural course. The government, though, did come out with that 5-point plan, which really didn't do much. The anticipation of the meeting did more for the rupee than the actual outcome of that meeting.
Correct.
So, I mean, do you think on the RBI's part, it is better that they actually don't land up going ahead and selling those precious dollars to help this fall, which in the end may not even happen?
Correct. So look, I think the RBI is being rightfully careful in using the reserves, and they did the right thing first of all in building up the reserves when we were getting flows to begin with. Can the government change the current account situation overnight? The answer is no. Okay, even if you impose all these import duties that are being talked about, will it dramatically alter our external position? Unlikely. Now, a couple of things, right? Oil and electronics, we will remain reliant on imports for a while. And frankly, if the position is that the external balance fixing is a policy problem from a government angle rather than a central bank angle, I think that's a fair position to take.
The other side to this is the fiscal deficit. Firstly, do you see the fiscal deficit target being met? Secondly, the government is saying that they are buoyant on the tax front issue. Do you think that the GST, anti-money laundering measures, demonetization, all of this will show up favorably?
So no, we are a bit worried on the fiscal arithmetic for FY19. Our best guess is that the government needs about 13.1 trillion rupees of GST collections this year, states plus center put together. And this is actually, frankly, a very difficult number to pinpoint. There's been a lot of debate around what is the break-even GST collection. We've gone through all the state budgets, we've gone through the central budgets, and our best guess is 13.1 trillion is necessary. Currently, we're running at 95, 93, and you will get some seasonality during Diwali, hopefully. But it does look like we are going to be short of GST collections by a meaningful number. The second reason to worry would be the disinvestment target itself.
Yeah,
8,000 crores looks very stiff, especially if the
I think they're just at around 10,000 odd crores now.
With the LIC buying that bank, perhaps that number will go up, and there's some potential transactions the government is talking about.
But we are way into there already.
Correct. So in desperation, the government could extract some more cash from its public sector enterprises, more dividends, more buybacks. All of that is possible, but it does look like a significant risk to that 80,000 crores is around. And on top of that, there is expenditure slippages. So you've seen significant announcements on welfare, on housing, and healthcare. They may not contribute much this year, but it's nonetheless slippage on the margin. So we think that either through some kind of expenditure control in 4Q, which is very challenging, or some kind of desperate revenue raising measures may be necessary towards the end of this year.
The other angle of this also is, what the markets and probably the sentiment around the elections. I mean, the government has been making quite a lot of announcements of late with regards to different sectors. They came up with the MSP. Obviously, the implementation of that is going to be key. But how are you reading into the kind of moves the government is making across sectors? Even for sugar, they raised ethanol prices. So they're sort of, in a way, taking all these measures, but implementation is key, and the reaction to that now, people are saying the MSP, once it's implemented, will feed into inflation. which will make RBI's job that much more tougher.
Right. So then you go back to the things that says there's no such thing as a free lunch.
Yeah.
Okay. And that's where policymakers have to make trade-offs. Now, I do agree with your concern that some of these measures may have come too late in the day. So announcing the MSP increase and then the 3 new mechanism of implementing that higher MSP may have come too late in the day, especially for the Kharif crop. It is unlikely that too many farmers may see, and we are worried that it may not be implemented as rapidly. But that's chicken and egg. If you can, if these were implemented, if let's say the Ayushman Bharat program, the healthcare, were very properly implemented all across the country on day one, then the amount you have to spend on it would have been much higher than you can afford. Okay, so in a way, the ramp up of these projects kind of fits the fiscal arithmetic, but it may not fit the populist arrangement of things where you would want these things to have been fully effective on day one. Yeah. Okay, so it's a trade-off, and I frankly, we are concerned that the government's ability to deliver on these and the monetary ability to fund all of these may not be very high.
I want to shift focus now a little bit to the markets and dwell a little more there. So up until now, it was a little more the Q1 results that came out, the earnings performance of corporate India was a positive. So it was read into with a positive light. EPS targets are on the upper side. But macro concerns like CAD, do they weigh down significantly heavy? Elections, do they weigh down significantly heavy in terms of volatility? Or you give precedence to earnings and micro indicators which ultimately direct you towards growth?
Okay, so first I agree. Micro indicators and some of them are looking much better. If you look at the Lee Keqiang indicators in India, 203, electricity demand, rail freight volumes are actually moving up. The first quarter, if you strip out the banks, the BSE 500 delivered 23% profit growth. It's a great number. The problem is that even after 23, we actually saw earnings downgrades. Yeah. There weren't upgrades. And we did an analysis a little while ago where we demonstrated that from a one-year investing point of view, earnings growth in itself is not sufficient to deliver returns. You need earnings beats. Okay, and if stocks are seeing earnings downgrades, then they struggle to perform. So our concern is, yes, the micro is improving, but expectations are way ahead of where the underlying is. And if I'm going to see meaningful earnings cuts through the year, then I'm not hoping for.
So market expectations from these companies and the kind of growth performances that they put in, it has shot up sharply.
Has run ahead of itself. Now what happens is, why it's a classic psychological problem, I suspect, is we got 40% returns in the market last year. So sell-side analysts, in order to justify recommending buys on stocks which have become extremely pricey, have pushed up their expectations. They would have originally thought maybe a 15% growth is sufficient, are now talking about 20-25% growth, because you need to justify stocks with 50 times, 60 times, 70 times multiples. And that leads to the expectations being pushed up with the market. I did another chart where we demonstrated that the earnings expectations of analysts actually lags the market. So analysts push up their estimates as the market goes up and cut it when the markets go down.
But so then that again is in relation to the environment that you're operating in. So if you're expecting a company to give you a growth of 20-25%, you have to see the peripheral support that the company has in terms of what the government does, the investment cycle, liquidity that the company has,
yes.
Currency, which links the two.
Yes, so you're right. So if your point is, will the macro start to hurt the micro? We think it can. Unfortunately, the data, we've done charts on this for the last 15 years. The correlations are not easy to draw. So you cannot take the current account deficit in India and extrapolate it to volumes of an auto company or for a staple company. There is no correlation between that. But it is fair to say that if you're going to pay another $15 or $20 billion to your oil supplier, then your disposable income for stuff within India has fallen by another $15-20 billion. Okay, and therefore some consumption will be hurt in the country. It will happen with a lag because people will realize over time that their net disposable incomes are falling. Companies now, for example, are saying we will pass it on. If our input costs are rising, we have enough pricing power and we will just raise prices. But again, we did this analysis. The moment you raise prices, there is an impact on volumes. Right? Your sales will slow from where it would have been otherwise. And again, these correlations are fairly robust across categories. So now the answer to your question is yes, the macro will impact the micro. It may happen with a bit of a lag. Another risk to earnings estimates. So if you were 3 months ago saying that my company is going to grow 25%, you may now have to pare that down to 20% or less. There'll be a cut.
So where does one say that value lies? In the sense, you just said that analysts who wanted to justify the highly valued stocks to go ahead and give a buy rating to them have increased and upped their growth expectations. But nonetheless, those companies were bought into, and investors like them. But there is a price to value, and investors were paying that. Is there some sense of semblance in terms of how much you can exceed in terms of paying for that company in terms of value and growth potential?
So right, so there is always this debate that look, we are paying a higher multiple because there is a recovery in growth. So then we did that math as well. We said let's factor in the growth and see if we are overpaying or not. And the best way to do that is a DCF. Okay, so we took the consensus forecast and we said, look, while I think analysts are wrong and they are overestimating the earnings power of most companies, let's assume that those numbers are correct and then reverse DCF the implied cost of equity in all of these stocks. The implied equity risk premium in Indian equities is at all-time lows today. So even after I adjust for the growth that is expected, it is a significant re-rating of these stocks. And many of these stocks have seen significant compression of the cost of capital, which is very let's say opposite to what's happening in the debt market. We've seen bond yields rise, yet we've seen compression in the discount rates for these companies, growth adjusted. And that's why I argue that the valuations are not in my favor at all. And you'd be very careful in chasing risk. So the other point I make is that, look, I've been cautious on this market for a while, and that's not worked for some time. But valuations are never an indicator of timing. Okay, I could have sold something at 30 times earnings, gone to 60 times earnings. But valuations are an indicator of risk. And I say this in most conversations. If valuations are rising, I need to de-risk my portfolio, which means I would avoid liquidity risks. I will not buy the small mid-cap stocks as much as I would earlier. I would graduate more towards quality companies where earnings risks and operational risks are lower as well.
So currently, we all know where the valuations are a bit stretched, though they have been coming off a bit in most of the consumption names. You have NBFCs as well, which a few of them, which seem to be a little bit stretched. So are you saying that, that be a little more cautious in terms of taking a call on whether or not this growth will surpass the valuations for you?
Correct. I do think that will happen. So look, if you take a 5-year, 6-year view, the economic cycle will drive equity. So if you are seeing growth recovery, then over time you will see Indian equities benefit from that. But equities do not always move with growth. We've overshot too much, and you need to.
So it has to come back to.
It has to come back to where the trend is on the underlying economy. And that's why I think we're not there. I mean, the market's just fallen to where it was probably in June.
So one space, or rather two spaces that seem to be of a lot of interest now, and on the backdrop of what the currency is doing, has been the IT and the pharma space. Now, is just the currency move enough to support the kind of euphoria in some of these stocks?
My short answer is no. Because we are seeing an improvement in growth, revenue growth for IT companies, but this frankly is a bit of a normalization from a relatively slow period.
Because up until 2 years back, no one really...
Rightly, because this growth was decelerating. And slightly flippantly, I put it to clients is, in a way to say that IT is what you buy in India when you don't want to buy India. Okay. It's defensive. So why are you coming to India to then
if you don't
buy?
Want to make that that extra froth on top?
So this was not true, let's say 7-8 years ago, because IT was a growth story. Now we are not talking about growth. I mean, now the only argument for IT is defensive characteristic in an expensive market. Okay. On that count, these stocks have still become very expensive again because there are few places to hide. And if the currency is as volatile as it is, everybody is going to buy IT. I can understand that. But is this a growth sector? We are not convinced that it is.
From a long-term perspective also?
Yes.
maybe 5 years down the line?
Yeah, so let's say if this currency is depreciating as much as it is, over time...
Because the deal pipeline seems to be improving.
Improving, yes, but it's still not enough to drive double-digit growth.
Yeah.
You'll go to a 9-10% maybe growth rate for the pack. Maybe one company does better than the other, is always happens. But is the Indian IC sector getting into mid double-digit growth? We are not convinced that it is.
So more of a phase of consolidation.
It is a consolidation, and our worry is that at some point in time, the gains from the currency will be taken away by the customers as well, because they know that Indian IT companies are seeing expansion of margins.
Yeah.
So there may be pricing pressure. So we'll see how this evolves.
Yeah.
But from a market perspective, there seems to be a significant overcrowding in IT names at the moment. It's the only defensive people can think of.
And people are finding refuge in pharma also.
Yes, but pharma is not ubiquitous.
Yeah.
There are pharma companies that people like and some that you don't like, because everybody's got their own specific issues. So you can't basket buy a pharma sector, but you can basket buy IT.
Yeah. The other one is obviously this is a big space which is in focus right now. A lot of moving parts here. Financials. You have the PSUs on one side. You have the private retail banks on one side. You have the NBFCs on one side. Housing finance companies. You dissect them and you see them. A lot of announcements, a lot of news focus in this space. How did you read into the merger announcement, the capping of the TER, and obviously private sector banks and their leadership not getting a transition into the next leg?
Right, so I'll refrain from commenting on the merger because we don't cover those 3 specific stocks. But that is something that has been on the government's agenda.
Just in general, the consolidation within that space.
Right, so that has been on the agenda of the government for a long time. And if this is happening, I suspect this is not the only one that they're thinking about, and may perhaps consider other forms of consolidation as well. And if you've got some small PSU banks who are on the preventive corrective action list and who can no longer lend, then it makes sense to kind of consolidate them into a larger public sector bank. Does this drive synergies over time? Does this lead to a better bank? I think only time will tell, frankly.
Because so far, I mean, the country's largest PSU bank, when the whole merging happened with its associate banks, I mean, the earnings performance just, was a complete disappointment for the markets. It's still trying to recoup from that.
Correct, but you don't know how much of the earnings was because of the consolidation and how much was because of provisions being as high as they have been for so long. You can't split out the impact of the merger yet. It's too soon and the numbers are too noisy to my mind. That said, the June quarter was the first where the PSU space did not book gross NPAs on net basis. March was a disaster in terms of gross NPA addition, but in June it was a negative number. Okay, they booked reversals more than they have booked additions, which is why the market started noticing it and started getting excited. Look, we've been calling the peak in stress for a while. Maybe it's happened. If not the June quarter, then maybe December or March, with the implementation of the RBI circular, all the large NPAs should wash through the P&Ls of these banks. Provisioning will continue because it's an aging phenomena to the NPAs, but it does seem that most of the stress is now recognized, not too many more skeletons in the cupboard, hopefully.
So have PSUs bottomed out according to you? Most of them have started front-loading provisions. The fresh slippages were also lesser in some of their books.
Yes, so the fresh slippages are lower. From a stock perspective, I think they will remain volatile, because while the gross NPA additions may slow down, you will see a lot of news flow around specific IBC cases. And suppose you get an announcement that in a particularly large case, the PSUs have to take 80% write-off because there's no bidder, then that's bad for the PSUs, because then incrementally there'll be more provisions. So you're not at the end of a news flow cycle for the public sector banks, and therefore I think the volatility in the space will remain very high. But from a slippage perspective, if not the June quarter, then December or March, depending upon what the Supreme Court does with that case now.
So till then, would you still, put your hand on the private retail banks and say that they're still a better bet compared to PSUs?
On a relative basis, yes. Because like I said, my investing mantra has been to avoid as much risk as I can. Okay, and at these private retail banks, the earnings risk is obviously much lower than it is at any of the other financial institutions. And that's why it would still remain my relative preferred pick.
And what do you make of this hula hoo around NBFCs? And do you feel that the debt market panic is sort of seeping into the equity side as well?
I think it's too early to tell. We shouldn't deny the possibility that if the credit markets were to indeed get tighter, it's only the first day, we will know over time whether it does, then it will have a real impact on the borrowing ability of many of these NBFCs. Because let's say, just as out of sentiment, if mutual funds, suppliers of money start asking for a higher yield from all of these NBFCs, even if they're AAA rated or not, then it will have a real money impact on their P&L. Is it going to happen or not? I think we'll figure out over time. It's just too early.
Because a few of them, and I wouldn't name them because you wouldn't be able to talk about them. But yeah, the creme de la creme of this space. I mean, valuations were steep.
Yes.
I mean, but their business prospects were equally good, and that's why the markets gave them a thumbs up. But now, I mean, does it look a little bit shaky? I mean, uncertainty creeping in.
Look, I'll make another comment here. When you are pricing in continued high growth and then paying a very high multiple for the high growth, you cannot afford a slip from a stock perspective. So if you see any miss, whether it is on the growth, whether it is on the ancillary issues, the stocks do take a beating. It happens all the time. Okay. Are the NBFCs in that spot yet? I don't know. It looks like, given they've crashed today. But will we really see an impact on growth? I think we'll figure out. If the credit markets do not normalize, then yes, their margins and growth will come under pressure, which is bad for very expensive stocks.
What happens to liquidity then?
So I'm hoping it doesn't, because those are the dire scenarios for all of us. I mean, however bearish you are, you don't want that kind of a play in markets. But look, one could argue that there's not too much space for money to go to. It's either debt or equity. In India at the moment, gold's doing nothing, real estate's doing nothing. So if not in debt, deposit rates are too low. In equity, then.
But there are also the timing of it. Like, does equity warrant investments at this time, or does debt warrant investment at this time, or another asset allocation?
Well, I can only give you my personal experience there. When I was trying to subscribe to an FMP last year, the bank returned my check because you couldn't raise the money for the FMP. Now you're getting a new FMP launch every day. Why? Because even with a 3-year lock-in, I can now make 8% post-tax. Inflation is still 4. So even if that goes up, I'm locking in a 3% real return for 3 years. Why do I need to take equity risk at expensive valuations? So today's issue will lead to some markdowns in credit funds NAVs. Hopefully that doesn't get worse. But even post that, the returns on debt compared to inflation are very attractive at the moment.
All right, interesting. Anything in particular that you've studied deeply and you feel that pocket deserves attention and has incremental value?
Well, we struggle actually when clients ask us, what stock do you think will deliver 30% returns from here in 1 year? Because we don't have a very big list, frankly. We do think there is significant downside to the market, and I need better prices to get super excited about the market. On a relative basis, we think the rural stocks will do better. One of our arguments is that depreciation of the rupee actually helps transfer consumption from the urban consumer to the rural producer. Okay. Why? Because many of the inputs of the farmers are fixed. Water is free, power is free, fertilizer is fixed. But the top line, the agri price, is partly linked to the dollar. Many commodities don't trade to the MSP, but to the export or import price. Okay. So farmers are likely to see an expansion of top line, whereas the costs are fixed, and therefore an income growth is likely in rural India, which is supported, let's say, by whatever the government is doing on welfare. Okay. So on a relative basis, I think the rural stocks or the rural focused names could possibly be worth looking at. Within that, we are actually not too excited on the staples.
Okay.
The argument I've made is that Indian staples have gotten very expensive, but more importantly, Indian staples are re-rating while global staples are crashing. Right? And this disconnect is actually very rare. If you look at the historical charts across sectors, Indian sectors tend to move in line with the global sector flow as well, just at a premium. But for it to go divergent is very rare, and that's why we have gone very cautious on staples. And the other thing is, people think of staples as defensive, but this year the correlation of staples with markets has significantly gone up. So is it a defensive as well? I don't know. So within the rural space, we'd be slightly lighter on the staple side, but yes, the two-wheelers, maybe the cement makes sense as well.
You think
Tractors.
it does at this point?
So cement, we are convinced that the volume growth will come.
Okay.
Whether the margins will come or not is
Wait and watch.
yes, we'll see.
All right. Sanjay, Mookim, it was a pleasure chatting with you. Thank you so very much for joining us.
My pleasure being here, Davina. Thank you.
Thank you.
Thank you.